We've all seen the major swings in the crude oil market over recent months, but given the volatility over the past week, has this presented some new opportunities again for individual oil stocks? In this video, we're going to take a look at 4 stocks. Before we get into it, let's just remind ourselves what's been going on with oil. We have had this recovery off those April lows. And over the last week or so, we did see the price wobble again. The price of crude oil, West Texas crude, went from above $40 a barrel briefly back down to $34.50, that sort of area. But for now, at least, it's just looking like a retracement in that overall trend. And we are seeing quite strong performances by individual oil stocks, by many of them anyway. So I thought we'd take a look at some of these and see where the opportunities are. We do have, I think, one trade running at the moment. So we've got a Brent oil position running anyway from $40 a barrel. But from the last video we did on stocks, we're long BP from about £3.13. They're currently just below £3.30. We'll revisit this and look at 3 other stocks, see where the opportunities might be and whether we can get some more trades on. Hello, I'm David Jones from Capital.com. I thought we'd do an update on 4 different oil stocks, given, of course, the massive volatility we've seen in the oil market this year and particularly over the last few months. So in this video, we'll take a look at the news behind 4 of these stocks, take a look at their charts in more detail and see whether there's an opportunity and perhaps get a couple of trades on. As usual, if you're watching this and you're not subscribed, if you can click on subscribe, support the channel, and we'll continue to push out what is hopefully lots of interesting content like this in the months ahead. To kick things off, let's start with the oil giant BP, listed in London and New York. In London, it's the 10th largest company on the FTSE 100. So despite the declines in the share price, still obviously a massive company involved in all aspects of the energy business, exploration, refining, delivery, all of that. I think BP is a name that we're all familiar with. Recently, because of the lack of demand, the drop in price for oil, it's announced plans to cut 10,000 of its workers worldwide. That represents about 15% of its global workforce. It's also said that it's getting ready to write down up to about $17 billion worth of its global oil and gas assets, again, driven by the collapse in the price that we've seen, and also, of course, the fall in demand because of the coronavirus. And it's influenced its forecasts. It says that between 2021 and 2050, it expects the crude oil price, Brent crude, to average around $55 a barrel. So we've seen plenty of volatility for the share price. We bought BP last time round. Is it still a buy? Let's take a look at the charts. So here's the BP share price, been in decline since, October 2018 from about £6 a share, traded as low as about 225 recently, but it's probably this slight recovery that I want to focus on over the last few months. So we bought in the end of April around about £3.13. The price has moved higher. It's traded as high as 370, 375, that sort of level. And it's pulled back again. But I think assuming we're going to see continued recovery in the oil price, we've had some bad news out from BP in terms of job losses and writing down assets. Share price has been under some pressure, but investors often view announcements like this as actually positive from a medium-term point of view, that the company is doing something to address the change that we've seen in the oil market. So for me at the moment, that recovery in BP is still positive. We've got what looks to be pretty good support around about 280 to £3. That's where the share price slipped lately. So I think in the short to medium term, perhaps we will see another push back up towards the 370 level. So for me, with that existing position in BP, I'm happy to continue to run it. At the moment, it's slightly in profit. Our risk was, I think, £200 on that trade. So we're slightly in profit, but not enough just yet to justify moving the stop loss. So we'll continue to run it. Back in April, of course, we saw this momentous move in the oil price where the front contract actually went negative. And what was driving this was the cost of storage. So we have looked in recent videos at a storage company Frontline. They're listed in Norway and also in the US. And they're in the business of oil tanker storage, moving oil around the world. But of course, as we had this oversupply and lack of demand,
these massive oil tankers ended up being used as floating storage units. So not surprisingly, we saw the price of the likes of Frontline really soar sort of late March and into April. The trade we did last time round was going short. Went short Frontline. We'll see the outcome of that trade. Basically taking the view that the price had run too far up. It did fall quite heavily, and I'm just wondering, is maybe now the opportunity to go the other way and be a buyer? The company has announced plans to raise $100 million, I think, via a share sale to expand its fleet, so to give it more oil tankers. It already has some on order, so it's expecting perhaps a return to normality and sees opportunities there. But is there an opportunity for us as investors? Let's take a look at the share price of Frontline.
So here's a quick update on that trade. I said we closed the short. We ended up closing the short on 18th of May in Frontline. I think the risk was the usual £200, trailed a stop down in the end and came out for £455 profit as that share price fell. But let's do an update. Let's take a look at the share price now and see if actually should we be a buyer. So just to take the long-term view, first of all, we've got this chart going back to early 2018, and you can see that the broader trend of the Frontline share price has been higher. Then, of course, we saw the shares really accelerate into April, end of April, on the lack of storage, where storage has been charged at a premium. So storage companies like Frontline really soared. I'm looking at the Norwegian listed share here. We ended up going short pretty near the top, saying that, well, actually, has the move been overdone? Since then, we've seen the price come back off heavily. But let's just take a look at what's been going on so far this year. So I do think it is interesting down here. You know, just before prices really started getting a move on, we'd seen pretty good support ahead of the sort of 66, 67 area. Down there, we've got these lows down at 57 from 9th of March. So for me, I could be tempted to be a buyer down here. You know, we've seen a lot of that euphoria, that froth has gone away from the market. It does seem to be trying to form a base above 70. We've seen it move a bit higher the last couple of days. Looking at the RSI down here, it had an attempt at going oversold. Didn't quite get oversold, but clearly has cooled off a lot from those April highs. MACD has been a little bit flat as the volatility has died up. But for me, the opportunity here is to be a buyer with a stop the other side of those March the 18th lows. March 18th lows are around about 67. So I'm going to buy and put a stop in at 65. Let's just set that up. So if I buy 175 shares where they're trading now, put a stop loss in at 65, it's my normal risk of a couple of £100 on the position. Let's just send that through. And again, I think if we return to maybe a more normal environment, back down at these levels, the lows for the past 3 months or so, you know, seems to be a fair enough point to get in on the position and see if it can push back up to maybe, you know, 100, 110, that sort of area. Then we'll review it then.
Given the news about Chesapeake Energy in recent weeks, I thought this would be an interesting one to cover. Chesapeake had been a major player in the US shale fracking boom. Although saying that, in recent years, over the last 5 or 6 years, the share price, broadly speaking, had been in decline. But at the end of the last year, it was still trading just below $200 a share. The price at the moment, at the time of recording, is around about $19 a share. So clearly the share price hit really heavily this year. Its latest quarterly results showed a first quarter loss of $8 billion. And just this week, it said it was preparing to file for bankruptcy as it missed an interest rate payment on its debt. It was due to pay, I think it was on Monday of the week just gone. Missed that. It's got something like $9 billion worth of debt, and the company said it's preparing for bankruptcy. We've still seen plenty of volatility in the price running up to this. I think lots of people have been short, expecting hard times for the company. Then we did have a short squeeze that saw the share price more than quadruple, but then plunge fairly quickly. So for me at the moment, it's clearly we're going to wait and see what happens. Let's just take a quick look at that volatility.
I just thought I'd show that short squeeze for Chesapeake, just how dramatic it was. You can see the share price was bumping around in the mid-teens and then just soared higher, started moving from $18, went as high on our platform touched 77, and then we've had the subsequent collapse again back down to $18.80, that sort of area. So we'll come back to this in the future if things change, depending on what happens with this bankruptcy, and see if there is an opportunity. But for me now, let's just see how the news pans out over the next few weeks.
And finally, we'll look at ConocoPhillips. We looked at those last time around, put an order in. The order didn't get filled. Perhaps we'll have a second bite of the cherry this time. So they're involved the exploration and production of oil and natural gas. Big name, again, of course, like BP. Its first quarter results saw revenue halve. This was, of course, a trend that we saw across plenty of these oil companies. And it said it was going to cut its production down and ended up cutting production by around about 400,000 barrels per day. And of course, that was try and balance off the oversupply, lack of demand in the oil market. But it has recently said that it's considering reinstating at least some of this production, considering how strongly the oil price has bounced back. Of course, I suppose the danger here is they ramp things up and we still have a lack of demand due to economies not operating as normal, even though they're coming out of lockdown. But let's take a look at the ConocoPhillips share price and see where the opportunity is.
I think ConocoPhillips is maybe one of the more interesting ones out of today's video. We have this recovery that's been going since March. We tried to buy into it last time round. Missed the order with the buy signal off the MACD back then, end of March, and this trend has continued higher. So let's just switch this to a shorter term chart. So this is a 1 hour chart now of ConocoPhillips, and you can see that trend line had done a great job over the last 2.5 months now. It has fallen out of it over the last few days, given some of the market volatility we've seen. But I think when I always say, when it comes to trend lines, just because it's fallen out of a trend doesn't necessarily mean that trend is over. It just means we might see a continuation of that trend, just at a slower pace. So I'm quite tempted really to be a buyer here. And I think for me, the obvious place for stops, the other side of 37.50, lows in early May on the way up. It's traded as low as about 41 so far. I'm recording this just ahead of the market open. So what I'm going to do, I'm going to set up a buy order with a stop, probably down at, let's say, 36.50, and really looking for the market to push back up again towards this $50 mark. Let's just set that up. So the market close yesterday was $43.43. I want to buy 37 shares. I'm going to buy at 43.30. So a bit of volatility today, and that order could get filled or over the next few days or so. If the order gets filled, put a stop loss. You can see it on my chart here. Put a stop loss in at 36.50, and I think that's a good level for a stop. It's a good distance to the other side of this sort of slight sideways range early to the middle of May. If it breaks below there, to me, then that trend does look to be over. But for now, I'm going to take the view that even though that trend line's broken, we've fallen out that trend line. Perhaps we will still see another push up to $50. Let's just get that trade in. So there we go. Our order is placed on Conoco. I think this is probably going to be the more interesting one to watch over the next few days, to see if it can start to build a base down here and have another run back up above $50. So 4 companies covered. We'll leave things there. So from me, David Jones, and Capital.com, good luck with your investing and trading. For more trading videos just like this, please subscribe to our channel.